Walmart, ticker symbol WMT, generates more revenue than Microsoft, Nvidia, and Verizon combined. Over the last year, they've generated $725 billion of revenue. They are bringing in more annual revenue than any company on earth aside from Amazon. Yet Walmart is not a tech company. They own and operate low-price retail stores, and they're really good at it. That's a mature business with low margins and slow growth. Walmart is not growing fast. But recently, Walmart has been priced like a fast-growing tech stock. Something happened that made Walmart's stock price surge 228% in the span of a few years. This was viewed as a high-quality but defensive stock whose price barely moved for decades. A large part of this increase in stock price is a re-rating of the stock's multiple. The company over the past few years has been trading at a higher price to earnings multiple than it ever has. A slow growth company is trading at a 35 to 45 P ratio. This company used to trade in the 15 to 20s. Walmart is currently trading at a forward-looking P ratio of 35.86. And that's after the stock has fallen off 22% from its all-time high and sold off 9.15% in one day following its latest earnings report. This is Walmart's worst one-day loss in 4 years. Yet the stock still might be expensive. It makes highly valued tech stocks like Nvidia look cheap by comparison. Nvidia is currently trading at a 24.1 forward-looking P ratio. And over the trailing 12 months, that's a 33.21 P ratio. But Nvidia's earnings are up 80% year over year. Walmart doesn't nearly have that kind of growth. In today's video, I'm going to give my thoughts on Walmart's latest earnings report. I'll explain why the stock sold off 9.15% despite showing a beat in the latest earnings report and a raise on guidance. I'll give my thoughts on whether Walmart stock is still overvalued after this recent sell-off. I'll explain the actual reason for Walmart's re-rating higher and why it's actually trading at a higher P/E ratio. The story is interesting and it does have its merits. And finally, I'll give a price projection for where Walmart could be in the coming years and at what prices I would actually consider buying Walmart stock. With that said, let's roll the intro and get into today's stock analysis video.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Today we're going to be taking a look at Walmart stock after its recent 9% sell-off following earnings. And if you want to use the same exact research tools that I do, it's all available at dividenddata.com. We currently have a 50% off sale where you can lock in half off annual membership. Click link in the description and pin comment in the video, or scan that QR code in the bottom right corner. So before I dive into the latest earnings report and a big picture look at Walmart stock, I want to focus in on Walmart stock being expensive, the rising PE multiple, and the recent sell-off, and how some of this could have been predictable. So you can see here in our PE Analyzer tool, over the past 5 years, Walmart has traded at a 25.08 median P ratio. And it really never got above a 30 forward-looking P ratio until 2024. Prior to this point, it was always in that 15 to 25 range for the most part. And a lot of the stock price growth at Walmart is because of this re-rating higher. There was a time where Walmart was trading at a forward-looking 46 P ratio. That was just a few months ago. And even after this recent sell-off back down to a 35.86 P ratio, over the past 5 years, this is still in the 68th percentile. So it's well above the median, but it's not at its all-time high in outlier. So the stock is getting less expensive. However, on a 10-year view, the median is 22.91 for PE ratio, and the current is in the 84th percentile, still well above average and nearly at that 90th percentile mark. And this is a company with 35% earnings per share growth over the past 5 years. That's a 6.5% compounded annual growth rate. Again, using Nvidia as a comparison, Nvidia is trading at a forward-looking P ratio of 24.1, which is actually in the 19th percentile over the past 5 years. The median multiple in that time has been 38.3. And Nvidia has actually been growing as a business, like historical levels of growth. 1,397% increase in earnings per share over the past 5 years, growing at an 82% compound annual growth rate. And just in this past year, it's up 83% year over year. So while Walmart has a fantastic business model and it gets priced at a premium due to how durable those cash flows are perceived, and it has gotten a re-rating upwards due to some actual real business things that are pretty interesting around digital advertising and their subscription business, and I'll get into all of that. The reality is that Walmart stock in today's market is pretty expensive. Walmart's also known as a dividend king. They've been raising their dividend payment for many, many decades. We're talking 50 plus years of consecutive dividend increases. However, dividend growth isn't that high. It's up 35% over the past 5 years. That's a 6.19% compound annual growth rate. And it's currently trading at a 0.95% dividend yield. And looking at Walmart's dividend yield, this is historically on the low end. The median over the past 5 years is 1.38%, and the yield got as low as 0.7% earlier this year. If we look going back to 2007, Walmart has a median dividend yield of 2.05%. We are currently in the 7th percentile. It's a major outlier to the downside. Now I'm going to take a look at the value graph tool we have on dividenddata.com. It's another way to see the difference between the implied fair value of the stock and where it's currently trading at. And we do this based on different metrics: earnings per share, dividend, free cash flow, operating cash flow, revenue, etc. And this works by taking the median multiple that the stock trades at. So in this case for Walmart, we'll look at the forward-looking earnings per share. The median multiple, as I said earlier, was 25.08. It's currently trading at 35.86. And you can see if the stock starts trading back towards its 5-year median PE ratio, which is honestly pretty reasonable for a company like Walmart. It just brings it down to like what Procter & Gamble trades at. That would imply a fair value of $72.63. Meaning Walmart stock today is still 43% above the implied fair value. And this is what I mean in that it's been kind of obvious that Walmart could be at risk here. It's been trading well above its historical fair value range, and it's even worse over a 10-year view. And so far, the earnings growth hasn't been backing it up yet. This is true on all the metrics we look at, whether it's the dividend. As I mentioned, we already took a look at that with the dividend yield. But this is another way to see it with the price versus fair value. If the stock returned to a median dividend yield of 1.58%, that would imply a fair value of $62.66, which is 39.7% downside from here. The stock even looks rich based on multiples of operating cash flow, trading well above fair value. The same is true with revenue. So our value graph tool here helped identify that Walmart stock was trading well above its historical range of earnings multiple. The stock was looking expensive. And if you're buying Walmart stock when it's priced at a premium, then you need it to perform and have high growth. Any negative signal or sign of slowing growth, and the market will likely sell off and lower that multiple. And that's what happened here with Walmart in the latest earnings report. It sold off 9% because there were some negative signs in the earnings report. So I'll dive into that, and then I'll come back and do a price projection on Walmart stock, and I'll give you an idea of what stock price I would buy Walmart stock at. And if you want to use the value graph and all of our other research tools, sign up for the founder's sale of dividenddata.com. You can get 50% off annual membership, and you can lock in that discounted price for life. So let's start getting into that earnings report. I'll start with the headline negative number that was one of the main reasons why the stock sold off, and that was comparable sales growth. It was up 2.6% year over year, excluding fuel cost. This was actually the slowest comparable sales growth since 2020, and it was well below analyst expectations, which were in the 3.5 to 3.8% range. And this is what I mean, that if you're trading at a more premium valuation, you are implying perfection. You're implying high growth needed in order to back it up. So when there's a sign of slowing growth at a company like Walmart, you're going to be vulnerable of a 9% drop in a day, despite the implication of Walmart being a safe defensive stock. It's a great business. Honestly, it's one of the best businesses in the history of the world. It's going to be around for decades and decades and decades to come. But that doesn't mean you can pay any price for the stock. But let's dive into the second quarter earnings. Because the market, they're not complete idiots. There is a reason why Walmart stock has been re-rated higher in the past few years, and I will dive into that right here. Now, one, over the past decade, Walmart's e-commerce business has been improving rapidly. They are now basically a very strong number two behind Amazon, and they're a legit e-commerce player. Their platform gets tons of traffic. It's also a platform for third-party sellers as well now. And Walmart's global e-commerce sales grew 23% year over year, and that was led by store-fulfilled pickup and delivery and their marketplace. But these next two things I'm about to mention are the main reasons why Walmart stock has been re-rated higher. And a lot of it is related to that e-commerce business, which has been growing in recent history. It helps power these other two parts. And the main one I want to focus on is their global advertising business, which is up 38% year over year. Walmart US advertising is up 38%. Now, the reason why I'm mentioning this is because advertising is an incredibly high margin business model. The most profitable companies in the world are digital ads companies. Google search prints money, YouTube ads prints money, Meta ads prints money. And Walmart, they're not stupid. They've been paying attention to Amazon, what Amazon has been doing. And Amazon advertising is a money printer for them. It's an incredibly profitable business. If you're not familiar with this, this is basically the sponsored listings on Amazon.com. And the reason why this is such a big deal for companies like Amazon and now Walmart is because e-commerce is an incredibly low margin business. Retail is an incredibly low margin business. However, they can benefit from all of the traffic, the customer data, and they can actually generate much stronger profits with their advertising business. And Walmart's advertising business is really interesting because, they have the app, they have the website, but then they have the entire retail presence as well. So they have ads within stores. They have these like machines that track you in stores and you can get notifications telling you to buy a product when you walk near it. And this is going to be big in the long run. This is going to generate a ton of profits for Walmart. I mean, just think about it. They have 150 million customers who shop at Walmart online and in stores each week. So their advertising business at Walmart is going to be a huge growth driver and a big part of actual driving more profits to the bottom line at Walmart. And then the second big thing that I would mention is their membership fee revenue. That grew 17% year over year. So what is Walmart Plus? Think of this as Walmart's version of Amazon Prime. Again, another great business model that Walmart has operating on top of their low margin e-commerce business. And why is this good? Because it's recurring subscription revenue. So what do you get with Walmart Plus? You get free delivery, you get free shipping, you get a video streaming service that's bundled in, Paramount Plus or Peacock. You get savings on gas when you go to Walmart. Walmart also owns Sam's Club, which has a subscription model as well, the membership model of Costco. Notice how Walmart just continues to copy the best things of these other businesses. Other things, free pharmacy delivery, 5% cashback credit card, Burger King savings, and they just keep packing stuff into it. So Walmart is going to be growing this membership part of their business. And you can see in the 6 months that ended this quarter, the membership revenue grew 19% compared to 2025 in that same time period. And in terms of net sales, total revenue, it's a drop in the bucket compared to their actual retail business. But that's a much more low margin business. It's also not a subscription model. And what we know is that those kinds of business models typically trade at a higher multiple. And that's because they're more predictable and typically higher margin. So this is a part of the re-rating upwards for Walmart stock, a push on memberships and the digital advertising business. However, one thing I will push back on in the Walmart Plus bull case for Walmart is that I don't think it deserves the same multiple as something like Costco for their membership business. If you've been following Costco for a long time, you know they trade at a very high multiple, something that's like unheard of in retail. Currently, they're at a 45.47 P ratio, but their median over the past 5 years has been 43.58. So really what's been happening with Walmart is it's starting to trade more like Costco. But I don't think you can actually apply that logic purely to Walmart yet. And the reason is that Costco's membership business is much higher margin compared to Walmart Plus. Look at this stuff, free delivery, free shipping, a video streaming service they don't even own. All of these things actually reduce the margin and potential profit of this service. At Amazon, Amazon Prime has a bunch of benefits as well, and it's not pure profit. The Costco membership is nearly pure profit. It also happens to be super underpriced. That Costco membership is cheap as hell. So there's room for potential pricing power, and it will naturally continue to expand as Costco opens more locations. Their membership's up 10% year over year. And if we look at Costco's free cash flow, they generate $8.81 billion over the trailing 12 months. That's up 20% year over year. And a lot of the money that flows through to their bottom line, it's from the membership business. And the company trades at a higher multiple because 5, 10, 20 years from now, a lot of the bottom line profit growth is going to be that reliable subscription revenue that's super high margin and continues to slowly grow over time. But still, Walmart, they're making the right moves, growing that advertising business and the membership business. And that's part of the reason why they deserve to trade at a higher multiple. Now I was looking up what percentage of Walmart's profits actually come from the advertising business at this time. They don't disclose that in their earnings report. I used AI to kind of help me come up with a guess. And right now the estimate is that's roughly 1/3 of Walmart's operating income. So that's why you're seeing Walmart stocks start to trade at a higher multiple in recent years. And I think part of that is actually deserved. But now let's get into where I would actually consider buying Walmart stock, because I agree it's a fantastic business. I love Walmart. I personally am a big enjoyer of Sam's Club, which they own. I love that whole warehouse club membership model. But the reality is, I think Walmart stock is still pretty expensive. So what do I think is a fair price? I'm going to give you a few different ways to think about it. I'll give kind of what my back of the napkin math is on where I think Walmart reasonably should be priced. And then I'll do a price projection based on various multiples that Walmart could trade at. I will also do an intrinsic value calculation. Again, all of this is on dividenddata.com. So over the past 10 years, the median multiple that Walmart has traded at is 22.91. That's forward-looking P ratio. If it traded at that, it would imply a fair value of $66.35, which is 36.1% downside from here. The current price is $103, and that's after going down 9% in a day. And that current price is based on a 35.86 P ratio. If we assume that multiple going forward as being a fair multiple, and we take a look at analyst estimates for earnings per share growth at Walmart, we're currently expecting high single digits to low double digits earnings per share growth annually. So this is an uptick, but it would make sense as we have the faster growing and higher margin parts of Walmart becoming a more sizable part of their operating income. So you can see in fiscal year 2031, they're projecting $4.23 of earnings per share, which at today's price would be a forward-looking P ratio of 24.5. So right now, Walmart's trading at 24.5 times 2031's earnings per share. And if we assume the company trades at that 35 multiple all the way through to those 2031 earnings, that would imply a projected price of $151.98. And you get to that by $4.23 times 35.9. That would give Walmart a projected stock price in 2031 of $151, which would be 46.4% upside from here. That's 8.9% growth annualized, which is not terrible, but will probably lag the overall market. So in order for Walmart to have market-beating returns from here, it would have to get re-rated upwards. And if it ever went back down to that median 22.91, Walmart stock would then be down 6.6% through 2031. And even if it goes to a 28 multiple, which is above the median, it would only be 14.2% growth through 2031. That's 3% annualized. So again, it wasn't a market-beating return even with the current P ratio. But the max P ratio over the past 10 years has been 46.34. What would it be if you got re-rated and the stock continues to trade at a high multiple, more in that Costco range? What would Walmart look like then? Walmart would have a projected price of $196.17. That would be 88.9% upside through 2031, which would be 15.4% annualized growth. So in order for Walmart to deliver probably a market-beating return, it either has to grow its earnings more than is currently projected by analysts or it needs to be re-rated much higher. Now I'm going to take a look at the intrinsic value tool on dividenddata.com. With Walmart, I'm going to be using the advanced DCF calculator. It pre-fills with all of the financial data, and I'll enter in some specifics as well. So some changes I made here, I did some edits so that the CapEx basically matched what it was in 2026 all the way through, with some growth on the end going up to $33 billion in 2031. I assumed 5% overall revenue growth in the 2030 and 2031 years, so we're about 5% every year. And we're going to take a look at the base price to free cash flow multiple, and I'm going to be doing Walmart a favor here in terms of its valuation. I'm going to assume that it trades at the median price to free cash flow multiple of the past 5 years, which is pretty high. It's 45.88. In that scenario, it would imply an intrinsic value of $87.65 for Walmart, which is 15.59% downside from here. If the company traded at a 30 multiple, that would bring the intrinsic value to $58.39, 43.77% downside from here. But this is just some back of the napkin math by me. If you want to know what Wall Street analysts are currently grading Walmart stock at, the current consensus price target is $130. That's 13.7% upside from here. It currently has a 71% buy rating, with 24% saying hold. And after the latest earnings report, there was a Goldman Sachs analyst that raised their price target to $130. So that's my thoughts on Walmart's latest earnings report. It's a great company. I wouldn't be a buyer necessarily. It would need to be much cheaper for me to be interested, and or growth would have to accelerate. So I'd likely want to see the actual results of that advertising and membership model showing quarter after quarter that it's clearly accelerating the business growth. And even then, I would want to buy it at a cheaper multiple because this is still not a high growth company. As an example, even though Coca-Cola or Procter & Gamble, they're great companies, I personally don't buy those kinds of lower growth stocks unless they're super cheap. And if I'm going to pay a multiple like this, I need higher growth. So it's a great business. I would say it's a little on the expensive side still after selling off. I personally would be a buyer of Walmart stock maybe at a 20p ratio, that 20 to 25 forward-looking range. So if you enjoyed the video, found it interesting, make sure to leave a like, comment, and subscribe to the channel. And again, if you want to use the stock research tool I've shown throughout, it's all available at dividenddata.com. If you want to become a member, we have our 50% off sale. It's to celebrate the relaunch of the tool. It's had massive updates over the past month, and the user feedback has been fantastic. And the whole tool is basically designed to help you make smarter investing decisions. It gives you all the data you need and great visualizations that help you put your mental model of long-term investing around it. And if the tool helps you find just one better stock, it way more than pays for itself. So links in the description and pinned comment. You can scan the QR code in the bottom right corner. And with that said, I'll see you in the next video.